there, future property rock stars and curious minds. Welcome to the ACE Your RES Exam Key Topic Deep Dive series. We're a shortcut to being brilliantly well-informed, diving deep into the essential documents and concepts that shape Singapore's vibrant property landscape. Today, we're tackling something that's truly the golden ticket in, well, pretty much any property transaction here. When it comes to buying or selling property here, there's one little acronym that holds a colossal amount of power. OTP. It's not your one-time password for online banking, though. It can feel just as critical when you're waiting on that perfect home. We're talking about the option to purchase. This isn't just a document, it's the foundation of a property deal. And for anyone aiming to ace the Singapore real estate salesperson exam, mastering the OTP isn't just important, it's absolutely essential for your future career. You've got to know this stuff.
Indeed. The option to purchase is, well, it's fundamental. It's the document that really sets the stage, granting a buyer the exclusive right to purchase a property under specific agreed-upon terms. What's truly fascinating here, and what often catches people off guard, is just how many critical details, legal safeguards, and potential pitfalls are packed into this seemingly straightforward agreement. Understanding the why behind each clause is just as important as knowing the what.
Exactly. And to confidently guide your clients and, of course, ace that RES exam, you need to know more than just the definition. You need to understand the nuances, the gotchas, the recent rule changes, and crucially, what happens when things don't go according to plan. So get ready because we're going to unpack the OTP, its crucial considerations, and why understanding it inside out can save both you and your future clients a whole lot of headache and potentially a lot of cash.
Right. Our mission today is to equip you with all the nuggets of knowledge you'll need, turning potential confusion into absolute clarity and confidence. We'll be exploring what an OTP entails, dissecting its key terms, walking through the different processes for HDB and private properties, and highlighting some very real consequences if commitments aren't met. Think of this as your essential guide to ensuring your property purchase journey, or that of your clients, is as pleasant and hassle-free as possible.
All right, let's peel back the layers and see what makes this document tick.
What exactly is this OTP thing? Anyway, the foundation of a property deal.
Okay, so let's start with the absolute basics. What exactly is an option to purchase, and why do we even have it in Singapore's property market? It sounds like you're just reserving something, right? Like putting a hold on a really popular concert ticket, maybe.
You're spot on with that initial intuition. An OTP, or option to purchase, is a legally binding agreement between a buyer and a seller for the sale of a residential property. Its core purpose is exactly that, to grant the buyer the exclusive right to purchase that specific property within a predetermined period, which we call the option period.
Okay.
Think of it as putting a legal hold on your dream home, ensuring no one else can swoop in while you finalize your decision, conduct your due diligence, and arrange your finances. It sets a standardized framework of rights and obligations for both parties, making it a critical first step in the entire conveyancing process.
Okay, so it's not the final sale agreement itself then. This feels like a really important distinction, especially for the RES exam. What's the difference between an OTP and a sale and purchase agreement, or SPA?
That's an excellent question, and it is indeed a critical distinction you'll need to master. While the OTP often contains all the terms of the anticipated sale and purchase deal, and can act as the sale and purchase agreement once it's exercised, they are not strictly the same in their initial function. The OTP, at its heart, only reserves the buyer's right to buy under specified terms for a limited time. It gives the buyer choice without obligating them to buy.
Ah, okay.
A sale and purchase agreement, or SPA on the other hand, binds the seller to transfer the title and obliges the buyer to pay the full purchase price. The OTP gives the buyer the choice. The SPA is the commitment. It's a subtle but crucial difference in legal weight.
Ah, so the OTP is like the pre-engagement ring, giving you the exclusive right to consider the marriage. But the SPA, or the act of exercising the OTP, is the actual marriage certificate. You're committed to considering it with the OTP, but not necessarily to doing it. That makes perfect sense. And to get this pre-engagement ring, you pay an option fee, right?
Precisely. The option fee is a crucial component, and it's essentially the booking deposit the buyer pays to the seller to secure that exclusive right for the option period. This fee isn't just a formality, it holds significant weight. Now, the typical amounts. For private properties, this is usually 1% of the purchase price, though it can be negotiated. For example, a buyer might offer a slightly higher option fee if they need a longer option period, as a way to compensate the seller, for the increased time their property is off the market.
Right.
For HDB resale flats, the option fee must not exceed $1,000, and it must be $1 or more. This lower cap is a very important HDB-specific detail that RES candidates should definitely commit to memory. It's a frequent point of questioning.
Good tip. So what's the main purpose of this fee then?
Well, in exchange for this fee, the seller legally agrees not to market the property to any other potential buyers during the option period. This provides the buyer invaluable peace of mind and time to sort out their finances, conduct necessary legal checks, and make their final decision. From the seller's perspective, this fee also serves as compensation for the opportunity cost and time their home is off the market if the buyer decides not to proceed.
And how long is this magical option period where you get these exclusive rights? Is it the same for everyone, or does it vary wildly, like trying to predict Singapore's weather?
It definitely varies, and this is another key difference between private and HDB properties that you absolutely need to know. For private properties, the option period is typically 14 days. However, it is quite flexible and negotiable. It can be extended, sometimes up to 2 months, if both parties agree to the terms. We've even seen rare cases where extensions went up to 7 months, though those usually involve very specific, complex arrangements between the buyer and seller. This flexibility is a hallmark of private property transactions.
Okay, so quite flexible for private.
Yes. But for HDB resale flats? For HDB, the option period is fixed and non-negotiable at 21 calendar days. That includes Saturdays, Sundays, and public holidays. It expires precisely at 4 p.m. on the last day. This is a very specific regulation designed for HDB transactions to maintain a standardized and clear process. It's a frequent point of confusion for those not familiar with the HDB rules.
Wow.
There's no room for negotiation or customization here.
It's fascinating how such a simple document has completely different rules depending on the property type. It really drives home the point that for RES candidates, paying attention to these specifics isn't just academic. These little details can trip you up in the exam, and in real life, they can be the difference between a smooth transaction and a massive headache for your clients.
Absolutely right.
The devil's in the details. Key terms and clauses to master.
Now that we've established the what and why of an OTP, let's peel back the layers and look at the actual ingredients that make up this legal sandwich. Because, as they say, the devil is in the details. And for anyone serious about real estate, these details are exam hotspots and crucial for client protection.
Absolutely. A well-drafted OTP covers numerous critical elements beyond just the price and duration. It's about ensuring clarity and protection for both buyer and seller. Let's start by delving deeper into the financial components beyond that initial option fee. So, A, the money trail. Option fee, balance deposit, and the power of stakeholding. First, a quick recap. We've covered the option fee 1% for private, max $1,000 for HDB as the initial booking deposit that secures the option.
Right.
Now, the balance deposit is typically a larger sum. It usually makes up the remaining portion of the total deposit, which can be 5% or maybe 10% of the purchase price. So, for example, if the total agreed deposit is 10% and the option fee was 1%, the balance deposit would then be the remaining 9%. This distinction is vital for understanding the flow of funds.
So the option fee gets the ball rolling, but the balance deposit is where the bulk of the initial financial commitment really lies. And I've heard the term stakeholding monies. What exactly does that mean, and why is it so important for safeguarding both parties?
This concept is vital, and it's a crucial safeguard. The balance deposit is usually held as stakeholding monies by the seller's lawyers in their conveyancing account. Think of a conveyancing account as a special type of trust account held by lawyers specifically for client funds related to property transactions. It's legally separate from the law firm's operating funds. But these monies are not immediately released to the seller. They are held by a neutral third party, the lawyers, until the successful completion of the matter.
That makes perfect sense. It's like having a trusted referee hold the prize money until the game is definitely over and everyone agrees on the winner. Prevents what could be a messy situation.
Exactly. This prevents a potentially difficult situation where if the deal unexpectedly falls through, the funds are already with the seller, making recovery for the buyer much, much harder. It provides a layer of security.
So you mentioned risky alternatives earlier, where the money isn't held by the lawyers. What would that look like, and why is it generally a bad idea?
Indeed. There are rare cases where a purchaser might agree for these stakeholding monies to be released directly to the seller upon request, even before completion. This is generally not advisable because it removes a key safeguard. Without these funds being held by a neutral third party, it becomes significantly harder for the buyer to claim compensation or penalties if any issues arise, or if the seller breaches the agreement. So for any RES agent, advising caution if such a request is made is paramount.
Right. And when do these stakeholding monies actually get released to the seller? Is there a final checkpoint?
Yes, there is. The balance deposit is only released to the seller on the completion day, and this release must be explicitly approved by the purchaser's lawyers. This approval is contingent upon the satisfactory furnishing of all necessary documents from the sellers, ensuring that all obligations are met before the funds are transferred. It's the final check to ensure everything is in order before the money changes hands permanently, safeguarding the buyer's interests.
That's a huge safeguard. Now, here's where it gets really interesting for me. Timing is everything. Completion dates and coordination chess. It sounds simple, but I bet it gets complicated quickly, especially for sellers who are also buying another property. It's like a grand game of real estate chess.
It absolutely is, and this section is a minefield of coordination, especially for sellers who have other commitments. Parties must agree on a fixed completion date or the length of time needed from the exercise of the option for completion to take place. The typical period is usually 8-12 weeks long. However, this period can be shortened, for instance, no earlier than 6 to 7 weeks, often depending on factors like bank loan processing and how quickly CPF monies can be dispersed. Conversely, it can also be lengthened by mutual agreement if both parties genuinely require more time.
So it's definitely not a one-size-fits-all situation. What are some of the critical considerations sellers have to juggle during this period? It sounds like a real balancing act, with potential penalties if they miscalculate.
It certainly is a juggling act for sellers, and this is where careful planning is absolutely critical. A point you'll need to master for your RES exam and for effectively advising your clients. First, outstanding bank loans. If the seller has an existing bank loan, they may need to serve a 3-month notice of redemption to their bank. Failure to redeem on a specific date can incur significant interest in lieu or breakage fees. This is particularly common for SIBOR-tied loans, where banks may not waive these charges if the redemption date is changed last minute. Our sources emphasize that best practice is to inquire with the financier about potential penalties or charges before issuing the offer to purchase, essentially, before even granting the OTP.
Wow, that early.
Yes. This foresight can save a seller tens of thousands of dollars in unexpected costs. Imagine paying an extra 3 months of interest just because you missed a notice period. That's a real hit. Second, coordinating with a replacement property purchase. Sellers who are also buying another property need to align their timelines meticulously. This is where the Tetris analogy truly comes alive. This includes ensuring the replacement property is ready, considering any renovation times needed, and crucially, managing the refund of CPF monies from the sale of their current property to use for their next purchase. Any delay in one transaction can cascade into severe financial and logistical issues for the next. Agents often help clients create a detailed timeline to visualize this complex puzzle.
Makes sense.
And third, the rent-free stay request. A common request, especially when coordinating a move, is for the seller to stay in the property for a rent-free period after completion while the replacement property is being prepared.
Yes, I've heard of this.
It offers a much-needed buffer. Sellers often offer to pay utilities and maintenance fees during this period as a reasonable compromise. To protect the purchasers, who are now the legal owners, lawyers would draft a letter of indemnity and undertaking, which the sellers must sign. This legally indemnifies the purchasers from any losses, requires the sellers to reinstate the property to its original condition if their subsequent purchase falls through, and ensures a proper handover at the end of the agreed period. And just for clarity, a replacement property in this context refers to a second property purchased to replace the owner's current property, where the current property will be sold within the timeline required for stamp duty remission.
Wow, that's like playing Tetris with real estate.
Yeah.
So many moving parts and potential financial penalties if you don't plan ahead. This really highlights the agent's critical role in guiding clients through these intricate timelines and anticipating potential problems. But what about the property itself? I've heard the phrase, as is where is, thrown around. Does that mean you're buying whatever state the property is in, even if it has, I don't know, a secret dungeon?
Hopefully no secret dungeons, but you're getting at a very important point regarding due diligence, especially crucial for buyers. The as is where is clause is a commonly highlighted one in an OTP, and it means precisely what it sounds like. You are buying the property in the current state and condition that you viewed it in, save for reasonable wear and tear that might occur between viewing and completion. This places the onus squarely on the buyer.
So the buyer has to be careful.
Exactly. It's the buyer's responsibility to make all inquiries into the property's condition as far as practicable and be satisfied with it before putting down any deposit. This means if you viewed the property, saw a suspicious stain on the ceiling, but didn't ask about it or get it checked, you generally can't complain about a leaking roof after the deal is done. No buyer's remorse allowed here for easily discoverable defects that you should have checked.
So it's not a free pass for hidden problems, but it definitely means you can't complain later about things you could have easily seen or asked about during the viewing. That makes sense. What about things like furniture, or if there are tenants already living there? How do you ensure that's all clear in the OTP?
Clarity is absolutely key here. The OTP must explicitly state whether the property is sold with vacant possession, meaning it's ready for you to move in the moment you get the keys, or with tenancy, meaning current tenants remain and you inherit the existing tenancy agreement. It must also clearly state whether it's furnished or unfurnished. This is where an inventory list becomes your best friend, particularly for furnished properties or those with existing tenancy.
An inventory list. Why is that so critical? Sounds like a lot of extra paperwork.
It might seem like it, but it's absolutely vital for your protection and for avoiding future disputes. Without an accurate and complete inventory list, you risk taking over a property after a tenancy, unsure what items were originally there. You might not know what to ask a tenant to replace or what items were removed without your knowledge. Imagine taking possession and finding the expensive designer faucets gone, replaced by cheap, basic ones.
Oh dear.
Such cases, though rare, highlight how important it is to have expectations clearly set out in writing in the option and accompanying inventory list. Even for vacant possession, it's prudent to confirm if the fridge, washing machine, or custom bed frames you saw during viewing will remain or be removed by the seller for their own use. A good inventory list, ideally cross-referenced with the tenancy agreement, allows you to make deductions from the rental deposit to replace any missing items, providing a clear and undeniable reference point.
That's a real eye-opener. So it's not just about the big numbers. It's about making sure all the little screws and designer faucets are accounted for. It's these seemingly small details that can prevent major disputes down the line, and a good agent knows to emphasize them to their clients.
Precisely.
The OTP journey, step by step for HDB and private properties.
So we've got the what and the why of the OTP. Now let's talk about the how. Because the path to getting and exercising an OTP isn't quite the same for every property in Singapore. It's like navigating different road rules depending on whether you're driving a sports car or a family sedan. Both get you there. But the journey has different specifics.
That's a great analogy. The process differs significantly between private properties and HDB resale flats, and knowing these distinctions is paramount for anyone in real estate, especially for your RES exam. The legal process for a Singapore property purchase always starts with determining eligibility, then the OTP. Let's look at A, the private property path, tailored transactions. For private properties, the journey usually starts with the seller listing their property, which is then viewed by interested buyers. This naturally leads to negotiation on price and terms between the buyer and seller, often with agents facilitating. Once an agreement on price and key terms is reached, the seller typically hires a lawyer to draft the OPP document. This is a key difference because private property OTPs are not standardized by a government body. They can be customized to suit the specific needs and complexities of the transaction.
Right, more custom.
Yes. The draft is then sent to the buyer, or more commonly, the buyer's lawyers, for thorough review.
So lawyers get involved quite early in the private property process to tailor the agreement. What does that crucial review process entail, and what happens after that to make it binding?
During the review process, the buyer's lawyers will scrutinize every clause in the OTP. They conduct due diligence on the title and property. That means checking for any encumbrances, ensuring a good route of title, meaning a clear, undisputed ownership history, and confirming its availability for sale. They'll also make any necessary amendments to protect the buyer's lawful interests, clarify ambiguities, and once approved, submit the final text for the buyer's signature. After this meticulous review and agreement, the buyer signs the OTP and pays the option fee to the seller. This step makes the OTP a legally binding document, and an acceptance copy is usually sent back to the buyer, solidifying the agreement. This whole process is designed to ensure the buyer knows exactly what they're committing to.
So for private properties, it's a detailed, customized legal dance with lawyers involved early. But for HDB flats, I understand it's a bit more plug and play, right? I'm sure there are some very specific HDB rules here that RES candidates absolutely need to know.
Exactly. B, the HDB resale flat adventure, standardized and structured. HDB transactions have a much more regulated and standardized approach, which is vital to understand for the RES exam. For HDB resale flats, it is mandatory for the seller and buyer to use the HDB prescribed OTP form, which can be downloaded directly from the HDB website. Any other customized agreements, such as those provided by third-party lawyers or property agents, are not considered valid under the Housing and Development Act.
Okay, mandatory form.
Correct. This means you don't necessarily need a lawyer to issue the OTP itself, unlike private properties, because the form is universally standard.
That's a huge difference. So you can't just create your own terms for an HDB OTP, but beyond using the correct form, are there any non-negotiable steps that sellers and buyers must take before an HDB OTP can even be granted?
Absolutely. And these are critical prerequisites for HDB transactions that you must advise your clients on. First, the seller's intent to sell. The seller must first register their intent to sell on the HDB's MyFlat dashboard. This must be done at least 7 days before they can grant an OTP to a buyer. This intent to sell is valid for 12 months. Without this, no OTP can be legally issued.
Okay, 7 days before.
And second, the buyer's intent to buy and loan readiness. The buyer also needs to have registered their intent to buy on the HDB flat portal. More importantly, if the buyer is taking an HDB housing loan, they must obtain a valid HDB flat eligibility HFE letter beforehand, which is valid for 6 months. This HFE letter replaces the older HLE letter and integrates several checks. If taking a bank loan, an in-principle approval, IPA, or letter of offer from a bank is required before reaching the OTP stage and will definitely be needed when exercising the OTP. This ensures the buyer has the necessary financing in place and eligibility confirmed before making a commitment.
So the HDB prerequisites are very much about ensuring both parties are serious and financially ready, with HDB's stamp of approval before the OTP is even granted. What happens once those boxes are checked and the intent is registered?
Once all these prerequisites are met and verified, the buyer and seller can then negotiate and agree on the purchase price.
Yeah.
The seller then downloads, prints, and grants the HDB prescribed OTP to the buyer in exchange for the agreed option fee, which, as we mentioned, must not exceed $1,000. It's a very streamlined process, but with those important preliminary steps.
And there's another crucial step specifically for HDB buyers after obtaining the OTP, isn't there? Especially for those relying on loans or CPF. This seems like a common area for confusion.
Yes, there is, and it's a critical one. The request for value. For buyers taking an HDB housing loan or using CPF savings for the flat purchase, a request for value must be submitted to HDB on the next working day after obtaining the OTP.
Next working day, okay.
Yes. HDB then assesses and informs the buyer of the flat's value, which directly impacts the loan amount they can secure from a bank and the amount of CPF savings they could use for the purchase. This step is absolutely essential for confirming the financial viability of the purchase, as the loan and CPF usage are tied to HDB's valuation, not just the agreed purchase price. Failing to do this promptly can cause major delays.
So the HDB process is very structured, no shortcuts, and clear sequential steps. Once you've got the OTP, whether it's for an HDB or private property, how do you officially say, yes, I'm buying it, and move from choice to commitment?
That's where C, exercising the OTP, the big yes, comes in. It's the formal step where the buyer commits to the purchase, and it also has specific procedures for both property types. Generally, for both private and HDB properties, exercising the OTP involves the buyer signing the acceptance section of the option to purchase document. This is the official declaration of intent to proceed. Alongside this, the buyer pays the option exercise fee to the seller. This fee, when combined with the initial option fee, forms the full deposit for the purchase. For private properties, this combined deposit is typically 5% to 10% of the purchase price.
What are the specific differences when exercising an HDB OTP compared to a private one? I'm sure HDB has its unique regulations here, keeping things tightly controlled.
Absolutely. HDB transactions have their own set of rules for exercising the OTP. First, a witness required. For HDB, a witness must also sign the acceptance section. This witness can be a property agent or a Singapore citizen PR, at least 21, and not involved in the transaction. Ensures an added layer of verification.
Okay, a witness.
Second, the deposit cap. This is crucial. The total deposit option fee plus option exercise fee cannot exceed $5,000 for HDB flats. So if the option fee was $900, the exercise fee cannot be more than $4,100. This is a key cap to remember, very different from private property.
5,000 max, got it.
Third, the resale application. After exercising, both buyer and seller must submit their respective parts of the resale application to HDB within the agreed number of days in the OTP. Critically, these submissions must be within 7 days of each other. The application is only complete when HDB receives both Delays can hold things up.
Right, synchronized submission.
And finally, the completion date. For HDB flats, completion is usually within 8 weeks from HDD's acceptance of the resale application, though extensions can be requested case by case for legitimate reasons.
So the HDB process has very specific checks and balances. What about exercising an OTP for a private property? What are the key financial differences there?
For private property specifics, it's a bit different. The deposit amount. The deposit fee paid upon exercising is usually 5% to 10% of the purchase price, minus the option fee already paid. So if the option fee was 1% and the total deposit agreed is 10%, the option exercise fee would be 9%. This larger deposit reflects the higher values involved.
Larger deposit.
And the completion date. For private properties, completion is typically agreed upon as around 10 to 12 weeks from the signing of the OTP, offering a slightly longer period than HDB's standard 8 weeks post-acceptance. This can be negotiated based on the seller's move-out needs or the buyer's loan timeline.
Okay, so many little differences to keep straight between HDB and private properties. It really highlights why the RES exam is so important for ensuring agents guide clients correctly and why paying attention to these distinctions is absolutely crucial for your professional competence.
We couldn't agree more.
The sticky stuff. Financing, stamp duties, and backing out the, moment.
Okay, so you've signed the OTP, maybe even exercised it. Everything's going swimmingly. Or is it? This is where we get into the sticky stuff, the financial commitments, and what happens when someone gets cold feet or hits an unexpected snag. It's often where the biggest lessons and sometimes the biggest headaches lie for RES candidates and, frankly, for anyone involved in a property transaction.
These are indeed the areas where meticulous planning and due diligence truly pay off. A misstep here can lead to significant financial consequences, making it an exam favorite for questions about liability and smart practices. Let's start with A, getting your finances in order, the mortgage maze. The most crucial advice we can give you, and what you should impart to your future clients without fail, is this. Secure your loan approved in principle by the bank before you pay the option fee.
Okay, that sounds critical.
It absolutely is. This in-principle approval, or IPA, is a simple yet powerful pre-qualification process. It gives you a clear, official idea of how much you can actually borrow based on your income and existing debt. You really don't want to get this wrong.
That sounds like a golden rule right there. IPA first. But what's the real cost if someone skips that step and their mortgage gets rejected after they've paid the option fee? Surely it's not just a minor inconvenience.
The cost is significant, and it's a hard lesson for many. If your mortgage gets rejected after you've paid the option fee and you can't find alternative financing, you generally do not get your option fee back.
Oh, wow.
It's forfeited to the seller. As one of our sources bluntly put it, you forfeit it to the seller, can't have your cake and eat it too. The option fee serves as compensation to the seller for taking their home off the market for you. It's not considered a breach of contract by the buyer, but rather the agreed-upon consequence. From a seller's perspective, this compensates them for the opportunity cost and time. But for the buyer, it's a bitter pill to swallow, especially when it could have been avoided.
Ouch. That's a very expensive lesson to learn. Losing 1% of a private property's price is no small sum. So it's not just a small administrative fee if things go south. Are there any resources that can help buyers navigate this mortgage maze to prevent such a costly mistake?
Definitely. Many seasoned agents and buyers suggest engaging a mortgage broker, especially those with strong banking relationships. They can often pre-probe with various banks and advise if a loan will likely be approved before official submission, saving you time, stress, and potential forfeiture. Their interests are often aligned with yours. If your loan goes through, they typically get their commission. It's a pragmatic way to get expert, unbiased guidance.
Good advice.
And it's also important to note recent regulatory changes that impact loan amounts, which are absolutely vital for RES candidates. Effective September 30, 2022, the medium-term interest rate floor used to calculate the total debt servicing ratio, TDSR, and mortgage servicing ratio, MSR, for residential properties was increased by 0.5%.
Okay, a rate floor increase.
Yes. This applies to loans where the OTP is granted on or after this date. This means buyers might qualify for smaller loan amounts than before, further emphasizing the need for early financing checks and understanding current regulations. The TDSR ensures your total monthly debt repayments don't exceed 55% of your gross monthly income. The MSR is specifically for HDB and EC flats, capping monthly mortgage payments at 30%. These changes are designed to ensure greater financial prudence.
That's a huge nugget for our RES candidates. Get that loan approved in principle first and be aware of how recent regulations impact affordability. Otherwise, that option fee quickly becomes a forfeiter fee. But loans aren't the only big numbers involved, are they? B. The stamp duty saga can be quite the beast, adding significantly to the overall cost.
They certainly can, and understanding them is another exam essential with different implications for buyers and sellers. We're talking about buyer's stamp duty, BSD, additional buyer's stamp duty, ABSD, and seller's stamp duty, SSD. These aren't just taxes, they're strategic considerations in every transaction.
Okay, let's break them down, starting with buyer's stamp duty, BSD. When is that payable, and how is it calculated?
Buyer's stamp duty, or BSD, is an unavoidable cost for the buyer and is payable within 14 days of exercising the OTP.
14 days.
Yes. Its calculation is based on the purchase price or the market value of the property, whichever is higher. This is a critical point that can surprise buyers. If a valuation report reflects a higher value than your agreed purchase price, which can happen if you negotiate a good deal, you'll be required to upstamp on the OTP. This means you need to pay the additional stamp duty based on the higher value. Your lawyer should alert you, and you'll need to top up within 14 days from the valuation report date to avoid penalties.
Based on the higher value, okay.
Exactly. It ensures fairness and prevents underdeclaring property values.
So it's not just the purchase price that matters. The market valuation can also significantly impact your stamp duty bill. What about additional buyer's stamp duty, or ABSD? This sounds like it could be a really heavy hitter for some buyers.
ABSD is indeed a significant financial factor and a major consideration for many buyers, particularly those purchasing multiple properties. If this is your second or more residential property, you'll likely pay ABSD. The rates depend on your citizenship status: Singapore citizen, PR, or foreigner, and the number of properties already owned. The rates can be substantial, for example, 17% for a Singapore citizen's second property.
Oof, 17%.
Yes. And a key point for purchasers of replacement properties, those selling their current home to buy another, is that you must pay ABSD up front. You will only get the remission, if applicable, after your first residential property has been sold. This sale must occur within 6 months after the purchase date of the second property for completed properties, or within 6 months after the 2PAR-P or CSC issue date if it was uncompleted. This has significant cash flow implications. You essentially need the funds for both property stamp duties for a period, which can run into hundreds of thousands. It's a huge financial commitment up front.
That's a big deal. You could be shelling out a lot of cash up front for ABSD, hoping to get it back later. That requires serious financial planning. Finally, what about seller's stamp duty, or SSD? Who pays that and when?
Seller's stamp duty, SSD, is, as the name suggests, paid by the seller. It applies if they are selling the property within 3 years of its purchase date. The purpose is to discourage speculative buying and selling in the short term, promoting market stability. The rate decreases with each year of ownership within that 3-year period.
Okay, discourages flipping.
Exactly. An important exception here is for HDB flat sellers. They typically do not pay SSD because they can only sell after fulfilling the minimum occupation period, MOP, which is at least 5 years. This duration generally exceeds the 3-year SSD holding period, making them exempt.
So navigating stamp duties is a whole financial strategy in itself. It's not just about the purchase price, but also timing, ownership history, crucial details for any agent. But what if, after all these considerations, the loan, the stamp duties, someone just decides they don't want to go through with the deal? C. What if someone gets cold feet? Can they just, poof, disappear?
Not without consequences, particularly if you're the seller. The OTP is a legally binding contract, and it clearly outlines what happens. It's designed for certainty. If the buyer backs out, the situation is relatively straightforward, as outlined in the OTP itself. A buyer is not obliged to buy the property after signing an OTP. They can simply allow the option period to lapse without exercising it.
So they just let it expire?
Yes. The consequence, in this case, is that the option fee paid will be forfeited to the seller. This is not considered a breach of contract by the buyer, but rather the agreed-upon consequence for not proceeding. The seller keeps the fee and is free to put the property back on the market, having been compensated for the time it was off-market. It's a clear-cut outcome.
So a buyer loses their option fee, but doesn't face further legal action. That's a clear consequence, albeit potentially an expensive one. But what happens if it's the seller who gets cold feet? That sounds like a much more complicated scenario, especially if the buyer has already made plans.
It is indeed the more complicated scenario, and for the RES exam, this is a critical legal point with significant implications. If the buyer exercises the option within the option period, meaning they've committed to buying, but the seller then refuses to sell, the seller is in breach of the OTP. It's not as simple as just refunding the option fee and walking away. That would defeat the entire purpose of the OTP as a binding agreement to sell.
So the buyer has powerful legal recourse then. What actions can they take if the seller breaches the contract and tries to back out?
The buyer has powerful legal remedies demonstrating the true weight of the OTP. First, specific performance. The buyer can apply to the courts to seek specific performance. This means the court can actually compel the seller to complete the sale. The High Court case of Go Kartuk v. Samuel from 2022 is a prime example. The seller tried to back out after seeing a higher price for a similar unit. The court ruled the OTP was valid and ordered the seller to complete the sale, even empowering the registrar to execute documents if the seller refused.
Wow, the court can force the sale.
Yes, it shows the serious weight the courts give to a valid exercise OTP. You can't just change your mind. Second, damages. Alternatively, the buyer can sue for damages suffered due to the seller's breach. This could include costs like securing alternative accommodation if the buyer has already sold their previous home, or other financial losses resulting from the seller's refusal. Imagine paying for temporary rental, storage, legal fees. Because the seller reneged, those costs add up fast.
Wow, that Go Kartuk case is a real mic drop. So backing out isn't an easy option, especially for sellers, once that OTP is exercised. It really demonstrates the true legal weight of the option to purchase. It limits the seller's right to deal with others, and they face serious repercussions for changing their mind.
Yeah.
Absolutely critical for agents to understand and communicate.
Absolutely.
The URA curveball. Reissuing OTPs, a recent game changer.
Now let's talk about something that threw a bit of a curveball into the private property market in recent years. The rules around reissuing OTPs. This is a big one for the RES exam because it fundamentally changed how some transactions, particularly with developers, used to work. It was a significant adjustment.
This was indeed a significant shift, effective September 28, 2020. Prior to this date, there was a growing trend, especially among developers, to reissue OTPs, and it definitely raised some eyebrows and concerns. Under the old practice, sometimes called a loophole or a soft option, buyers would get a standard 3-week OTP for a private unit. They'd pay an option fee, maybe up to 5% for new launches. If they didn't exercise, they'd forfeit a portion, usually 25% of this fee.
Okay, standard practice.
But some developers were offering their own schemes, reissuing OTPs if the first one expired. This effectively gave buyers much more time, sometimes stretching up to a year instead of just the usual few weeks.
So it was a bit like a buy now, decide much later scheme. Why did buyers like this extended period, and what were the implications for the market? Sounds sweet for buyers, but maybe not great for market health.
Buyers certainly liked it. It allowed them to lock in early bird discounts without immediate full commitment. It provided valuable extra time to sell their existing property, accumulate more cash, or simply decide if they truly wanted to proceed, especially before paying significant stamp duties due 2 weeks after OTP exercise. Buyers might pay a small admin fee, maybe as $300, for this extension, making it seem like a low-cost way to hold a property.
I see.
However, analysts noted this practice might have created a false impression of market activities, as units were optioned but not truly sold, potentially misleading genuine buyers about demand. It also created what some called a vicious circle, where opportunistic buyers could use these schemes to renegotiate prices or back out without severe penalty if prices fell. Developers might have used it to manage inventory, but it introduced artificiality to transaction data.
So it could distort market perceptions and lead to less prudent decisions, creating a kind of property limbo. So what exactly did the Urban Redevelopment Authority, URA, do to address this?
The URA, through the Controller of Housing, stepped in with new rules, effective immediately from September 28, 2020, to address these concerns and encourage greater financial discipline. The key changes, which are critically important for you to know for your exam and for advising clients, include: first, no upfront agreements. Developers are no longer allowed to provide upfront agreements or arrangements to purchasers to reissue OTPs. The developer-run schemes were shut down. Okay, no more side deals. Second, a 12-month bar. A developer cannot reissue a new OTP to a buyer who had a previous OTP for the same unit that expired less than 12 months ago. Developers must inform buyers of this rule up front. Effectively, if you let an OTP lapse, you can't get another one for that same unit from that developer for a whole year. A 1-year cooling off, basically. Pretty much. And the purpose. The URA explicitly stated the standard 3-week validity is meant to encourage prudence. Buyers should commit only when ready and financed. Reissuing OTPs defeated this purpose. It was about bringing back financial realism.
So, the days of developer-sponsored near-unlimited OTP extensions are over. What was the immediate impact on the market and buyers, especially those upgrading from HDB to private?
Analysts immediately predicted a cooling effect as the speculative element was removed. This particularly impacts upgraders. They now face a much tighter timeline. They essentially need to sell their existing HDB flat first to avoid stumping up the ABSD upfront, which, as we said, can be hefty.
Right, that upfront ABSD is tough.
Exactly. An HDB upgrader might now need almost 40% cash and CPF within 3 weeks if they want to buy a private unit, a significant challenge if their HDB isn't sold. This forces a much more disciplined approach. The URA emphasized the need for financial discipline, especially given economic uncertainties, to prevent imprudent decisions.
So no more developer-sponsored limbo, forcing more discipline. But does this mean extensions are completely impossible? What if you genuinely need more time for legitimate reasons, not just speculation, like a loan hiccup?
That's a critical point. And the URA did provide a channel for flexibility, recognizing legitimate circumstances. While developers cannot unilaterally reissue, the URA's controller of housing is prepared to extend the validity of the OTP.
Oh, okay, through the controller.
Yes, this extension can be for up to 12 weeks from the original expiry date. That's an increase from the previous 8 weeks. However, it requires both buyers and sellers to agree to it. Home buyers or developers must provide their reasons for needing more time. This ensures extensions are for legitimate, unforeseen reasons, not just speculation. And crucially, it is also illegal to backdate an OTP. This new approach removed the developer's ability to grant extensions on their own terms and streamlined it through an official channel.
So, no more property market time travel or endless extensions, but a legitimate pathway if you truly need it for valid reasons. This really highlights the evolving nature of property regulations and why staying informed isn't just a good idea, it's absolutely key for any aspiring RES agent. Understanding these shifts and their why is just as important as knowing the rules themselves for your exam and for practical client guidance.
Couldn't have said it better myself. Outro.
Phew. We've journeyed through the intricate world of the option to purchase from its basic definition to the nitty-gritty of fees, timings, critical clauses like as is where is financing, stamp duties, and even those game-changing URA rules. I don't know about you, but I feel like I've just completed a mini obstacle course, and I'm definitely better prepared for any property challenges, especially the ones on the RES exam.
Indeed. We've covered why the OTP is far more than just paper. It's a legally binding document that protects or penalizes, depending on how diligently you approach it. Understanding the distinctions between HDB and private OTPs, the non-negotiable importance of financial checks like getting that IPA, the complex implications of stamp duties, and the severe consequences of backing out. These are all fundamental pillars of real estate knowledge. And the recent URA changes just underscore the dynamic nature of this field, always pushing for greater prudence and clarity, which is exactly what you need for your RES exam and your professional practice.
So what does this all mean for you, our amazing listeners, especially those of you burning the midnight oil for the Singapore real estate salesperson exam? It means paying meticulous attention to every detail, asking the right questions, and knowing when to seek expert legal and financial advice. The OTP isn't just a hurdle, it's a foundation for a successful and ethical property transaction. Master it, and you're well on your way to acing your exam and becoming a truly valuable asset to your future clients, guiding them confidently through one of the biggest decisions of their lives.
My final thought for you to ponder is this. Given the complexities and the legal weight of the OTP, imagine the discussions you'll have with future clients. What single, often overlooked detail within an OTP do you think will be the most critical for them to understand to avoid unforeseen complications in their property journey? Keep that in mind, and you'll always be one step ahead, truly earning your stripes as a property professional.
Fantastic point. Thank you for joining us on this deep dive into the option to purchase. We hope this has clarified this absolutely crucial topic for you. And to all of you studying hard for your Singapore real estate salesperson exam, we want to wish you the very best of luck. You've got this.